Hello guys, this is another one session that I'm hosting on a derivative part because derivative can be very important for a derivative processes, maybe for a forex processes, maybe for a hedge fund or mutual fund processes as well, and you may expect lots of questions in the interview as well. So sorry, already I have hosted two sessions on a derivative part, but I again would like to discuss with charts and key terms that you may expect questions on it, like ATM, OTM, then in ITM, in the money, out the money, or that at the money terms, and BP, break even point, or many other terms as well, how the options work and all. That is what I have decided to host one more session on a derivative part. I hope you will enjoy this and just see from an operation point of view, as well as you can even look from a interview aspect as well, because I don't want to provide any insight on a trading part, how you can trade and all, because there are so many YouTubers who are already they have developed decisions on the trading strategies and all, but I don't want to fall into it. I want to just cover the sessions from an interview aspect, as well as I would like to cover the key terminologies and techniques which can be important while working in a derivative process, as well as from an interview aspect as well. Okay, so let's start without wasting our time, because time is a very precious for all of us. We don't have time, but yeah. So if you can see to this chart, see, this chart will help us to understand the how the derivative options work and all. Sorry, see this. So the terminologies like ATM. ATM stands for at the money. At the money. Who are freshers, who don't know anything, they can write it down. Then there would be the terms which is ITM, in the money. OTM, out the money. These are the terms, key terms, which will help to the recognize the options for a trading as well, because on the basis of that you can find out the curative or unique options and the strike price where you can do the trade, and definitely you can earn the profit or loss. That is depends on the market and the other factors and all, but these are the key terms, so you can you know you may expect questions on this in the interview as well. If you're a fresher, maybe you're an experienced one, if you're looking for any other interview, like for a derivative process specifically, or maybe for a hedge fund interview, because this is like common, so you may expect questions on these areas, because derivative is one of the critical process, one of the critical even the subject where it feels very difficult to understand the key terms like this, and that is what. So even I would request you to follow my even YouTube channel or others YouTube channels, or maybe materials. Even you can go on the NSE site or other stock exchange site, and you can check this full information about it and try to read it. Okay, this is also important. So these are the key terms, so you may expect questions on. And apart from this, if we see to this, so this particular this would be your strike price. Strike price, it means the options that you are targeting to purchase, that that the uh, that the price would be the strike price. Okay, and the spot price basically would be the current price of that particular contract, or I would say the market price of that particular underlying assets. Or if you take example about the Nifty is indices, and if you're discussing about the spot price, then we'll check the price of a Nifty indices, Nifty 50 especially, right? So that would be your spot price. And the strike price, it means, let's say the Nifty price is around mm, this this would be your spot price, but you're looking for something. And if you purchase this particular option CE, which means call European, if you purchase this, so this will be your the strike price, right? If let's say if the market price means spot price, it break to this in such a way, so this area will be the break even point, so that your strike price will be braked by the market price. So after that, it will your contract will generate or produce some profit. You can see this area. So this gives the profit to you, lots of profit, right? And if you see this area, if the market price is less than the strike price, then this area definitely you will have a loss. Okay, so just it was like basic discussion about this, how the break even point and all works and all. So break even, it means actually it is breaking that the point, so where your contract, the negative figure will be turned into positive or profit actually. That the term or that the point would be the break even point. Okay, so we'll read this description. Let's see what the outcome will have after this. Each strategy has an accompanying graph at the lower right hand corner showing profit and loss at a expiration. The vertical axis shows the profit and loss scale. When payoff line is below the horizontal axis, it represents the loss and outlay for the strategy. The portion of the payoff line above the horizontal axis represents a credit or profit for the position. The interaction of the pay of line and the horizontal axis is the break-even point, not including transaction cost, commissions, taxes, margin cost, etc. This is very important. Okay, so you may expect questions if the break-even point that the break, and once you get a profit, so will be that the net profit? No, it will be your gross profit, excluding the other cost, commission, taxes, margin, and all. So I think in the last week there was one guy who was asking about this. When we get the profit from the contract, so will we get the premium back or not? Definitely you will get your premium back. And how can you calculate the profit? So if you exit the contract and suppose you have a, let's say, 20,000, then you will have to first of all deduct the premium value or premium amount, so which you have paid. Let's say your premium was around 10. Then once you debit this, you will have a net profit which is around this. Okay, so yes, once your contract would be in profit, you will have a your premium and the the whatever exposure will be there, so we'll get that. Okay. In the example, so here the for the explained strategy and a payoff table based on example are also provided for the better understanding each contract used. In the following example has a lot size and all. So let's see below. We can see the much information to understand. I'm not well. Still, I'm hosting this session, recording the session. Okay. Okay. uh, Bullish strategy. Okay. This is again bullish. It means if have a speculation that the market price or the indices price may go up in upcoming day, in upcoming time. So in that case, you may think about long call. Long means it would be not for a one day. This term is also important. So you may expect questions on this. So when you can make a long call strategy, and especially this would happen, suppose if you're looking for any derivative process interview or maybe for a hedge fund interview, because in a hedge fund, so you may see such names like bullish strategy, long call, short call, right? But yes, so you should know at least the basic information about it. You don't need to carry the information about the other stock exchanges, but at least you are aware about the NSE and BSE and how they work and all. That is also enough. Okay, that is what even I have taken this particular information from the NSE to discuss about it. Okay, so the strategy name is bullish. Okay, so view. So very bullish on Bank Nifty. Bullish it means positive. Who are a fresher, so for them positive on a upper side. Okay, so up. Okay, so strategy, you're looking for a buy the particular option, right? So it means buy call option. Okay, so risk, this is very important because I have seen that even this, I'm saying this by my from personal experiences as well. uh, Most of the operation manager, they ask questions on this area. If you get a loss from the particular put option or call option, then what would be your maximum loss? Okay, so if it is a indices, then your premium would be your maximum loss. Premium, total premium, whatever premium that you have paid, that would be your maximum loss. Correct? But if it is a stock or any stock and you have entered into the contract with a stock, in that case, if you carry that particular option till the maturity, so it means you want to exercise that particular option, so you will have to pay the additional margin as well to execute that contract. Otherwise you will be penalized from the broker and your contract will not be exercised. It means you have broke the rule of a derivative agreement, so the broker may penalize to you. Okay, that is what, so this is very important to understand here. So your maximum risk or the loss would be the total premium that you have paid, but this applies to the indices only. Sometime there would be an argument from the panel side as well. So what would be the maximum, loss when we purchase any put option or call option? And if you say this, yes, your the total premium whatever we have paid, that would be the maximum loss. That is correct. But if you see any further argument on it, Then so might be they are asking for a stock specific contract as well, maybe for a TCS put option, maybe for a TCS call option, Wipro put option, Wipro call option. So in that case, so this logic will be worked in a different way. To exercise the contract, it means that you are looking for a buy. So you want, let's say, if we'll go to the site and we'll check it if we have the account open. Mm, because I don't like to provide any, short information, and that is very dangerous. Because on the basis of my contact, if you see or if you face an interview and if you explain that, anything incorrectly, then that doesn't make sense. So, so eventually, okay. So let's say if you entered into any Wipro's, put or call option. This is the put or call option. Let's say we are very bullish on a Wipro and that we are looking for the strike price which is 620, and so we have a expectation that so it will that the achieve this price in the month of March, because uh, the up to the March there would be April, and April is the again would be the earning sessions where the companies will declare the earnings. That is what you are very bullish on it, okay, and now you have decided to purchase it. And now let's say you if you want to purchase this 800 quantities, so what is the margin required, which is 14,760 rupees, which is required to purchase this contract or to enter into this particular derivative contracts. And the quantities, let's see here, you can see the 800 quantities are around. And so very important is till the March, let's say if the price goes or break this particular point, that is 620, and the current market price, let's say this is March and there's a particular this the Wipro's price is above 620, 30 or 40. In that case, again, so you are bullish, you have a bullish view on this particular stock, and so now you have expectation that so it may reach to the 700 or maybe 800 in upcoming time, and that you want the all the 800 quantities in your account. Then how can you means exercise that particular contract? So you can wait till the March, and at the time of expiry, so the thus the derivative contract will be matured and it will be settled. At the time of settlement, suppose you have entered into call option, it means you want to purchase it, you want to purchase that the 800 quantities, then you will have to pay the additional margin which is required to get this 800 quantities. You have paid premium already, as well as now your contract is in profit, because from 18 rupees to, suppose let's say it has been increased up to 70 or 80 rupees. If you add that, so you have a margin in your account. Apart from margin, you will have to pay the additional margin, whatever or how much which is required to exercise this particular contract. Otherwise, if you don't have margin in your account, the contract will not exercise, and again it is a violation of the derivative contract, and in that particular case maybe the UN broker also can penalize to you, because this contract then broker will have to sell to someone else and they will have to exercise it. So it means it will auction simply in the market. They will request someone or ask or ask someone to purchase these 800 securities on behalf of you, and then whatever margin shortfall would be there in the process, that extra cost that you will have to bear. Apart from it, you will have to bear the other expenditures as well, commissions, the other the depository expenditures, the other shortfalls. So everything means there would be lots of expenditure as well as extra penalty as well. Make sure if you're looking for any trading and also don't wait till the maturity if you don't have a margin. Especially this applies to the stock specific contracts, and for indices don't need to worry about anything. If you are carrying any contracts till the maturity, still fine. But so it's a very high possibility if we wait till the maturity, the contract's premium may go, down proportionately, because the premium always calculate with the time. If the time is near the expiry, then the premium may affect proportionately. Okay, so it's better to exercise the contract before the maturity or before the expiry, and it is always good to exit from the contract to avoid further procedure. But from an interview point of view, so you may expect questions on this, even on a lot as well. So derivatives that the contracts work like, in a single, suppose if you want to purchase any Wipro, then you can purchase even one security as well. But here in the derivative contracts, we purchase the lot. Okay, so this is the difference between normal trading and derivative trading. So here we always purchase the securities in lot. Okay, so again, there was one question, the one of the my student there, he asked me actually, can we carry the derivative contracts for a next day, or for a maybe one day, 1 week or month? Yes, we can carry. So if we purchase this, the Wipro for a March, so till the March you can carry this. March, it means there would be a date. Month's last expiry date would be the expiry date for this particular March contract. So you can carry this contract till the expiry date of March month, right? So yes, you can carry for a day, you can carry for a month, but for a month only. So it's not a commodity market where you can sign the contract for next 5 years or 10 years. It's not like that. Okay. Okay. Now come here. Break even. Okay. So rewards. Reward, it means return, which is unlimited. Okay. Even that we can't calculate it, how much would be the returns, and that we don't have any, measure that we can calculate the return, how would be the returns when we entered into this particular contract, which is depends on the market. And if the market goes very high from your the strike price or break even point, then your contract would be in very huge profit. That depends. Okay, so that is what. So the yes, from a, even from an interview perspective as well. So if we see any questions on this, like what would be then the maximum profit? Unlimited. We can't predict the profit, how much would be the profit and all. Okay, a break even point, so which is very important. Strike price plus premium would be the break even point. Okay, so whatever premium that you have paid, right, and the strike price which you are targeting. So let's see here, we have an example. Okay, let's say, so this is a bank nifty means, which is one of the indices. Who are the freshers for them? I just wanted to write this indices. Okay, so we are looking for a buy one call option. Call, it means basically it's a buy position. Okay, to buy something. Okay, we are looking for a buy spot price. So the particular, the bank nifty's price is this, the current market price. Okay, which is 8,900. Okay, so lot, so we are looking for, let's say, one lot, because in a derivative contracts that we cannot purchase one shares or one, one quantity, but we'll have to purchase anything that is in a lot, and under one lot there would be the 20 quantities. This. Okay, so the strike price, it means that uh, the price which we are looking for a buy, or we have a speculation that the price may go above this, and it will above this and then will be in a profit and all. Okay, that is what this. So premium that you want to uh, pay to purchase one uh, lot, which would be around 500. But so 500 into 25, that you will have to calculate. So this would be for per unit, I would say, or per that the per shares. Then if you calculate this, 500 पंचवीस 50 75 100 something. This should be total that premium which is required to purchase one lot of bank nifty. Okay, and the break even point, so here. Okay, so you want to understand the situation as well. The strike price that you want to purchase the lot for this particular price, or for this particular the strike price. So where is this strike price? See it on the chart. Okay, this is a call option. Okay, here, because break even where the price will break to it, this point. And if the particular contract goes above this, so then it will have a profit. This area will give you the profit. And if the contract will be below this, the break even point, so it means till here, if you see, so this all the area will give you the loss only. And if the particular contracts again work beyond the, or below the, sorry, the below this particular 9,300 price, then you will have a loss. And here if you understand the ITM, O2M and ATM terms, then would be again better to understand from this. If you see this area, because you are in a call option position, right? So you are very bullish and you have decided to purchase the option, which would be this here, that this option that you want to purchase, buy, and you have paid around almost this price. Okay, so what is this exactly? O2M, ITM or ATM? There's actually situations which will help to recognize or to evaluate the contract's position, whether you are in a profit or not. Because if you see this, the market price of the contract is around how much, which is 8,900, but we are targeting for 8,800 only. So in that case, and you are looking for a call option, and the market price is something different, and you are looking the price, the strike price, which is something different, this one. So that is what, if if the spot price is greater than the strike price, then this would be your in the money. So your purchasing options, that is in the money, okay? But okay, but when this actually cross this price, this axis will cross this particular limit, which is 9,300, then only you will have a profit in your pocket. Because when you will have a profit, the premium that you have paid, this the strike price plus the premium which you have paid, if the contract or the market indices moves above this, only then you will have a profit. So that situations will be again in the money, in the money, because now your contract is in profit. So the terms you can define in a two different ways. While selecting the strike price or the contracts, in that case also we apply this logic OTM, ITM, or that in the money, out the money, or at the or again, so once you generate or produce some profit and loss, in that case also we apply this logic. Okay, we'll take the another one example and we'll try to understand. Okay, this is for short. Okay, hope you understand this. Okay, so I'll try to simplify this. Let's say the market price. Okay, okay, so market price of this, the Nifty, is around 3,000. So okay, 38,789.3 point something. Okay, this is the market price. So it means this is a spot price, right? If you purchase this particular Nifty, so you will have to pay this price. So this is a spot price. Okay, but that you want to carry this options for a long, and if you don't want to purchase this contract at if you don't want to target to the spot price, so that you are looking for 38,700, or let's say instead 700, you're looking for 600. All right, so this, and for the month of, there are again two types. Even contracts may expire on a monthly basis as well as on a weekly basis as well. On every Thursday your contracts will be expired. Okay, so let's say suppose you want to purchase this, and if you entered into this contract, so you will have to pay the premium, which is around, so 12,882.50 to purchase this particular option. So it means your contract or your the premium should be go beyond, so whatever the price that you are paying to purchase this, then only your contract will be in profit, right? Otherwise it's not possible to gain the a profit on this particular contract. That is what most of the time we select the in the money call options to get the good movement in the options price. And then only if this particular contract goes above this particular let's say your strike price as well, whatever strike price that you have selected, in that case also that we call like so now your axis is breaking to the strike price, so it means that is a break even point, and after that so you will have a huge profit in your pocket. But actual at a ground level, when you do the trading, so that work in a very different way, because we don't wait to till the that the exercise or mature this particular, expire this particular contract, because before that we try to exit from the contract and we try to book the profit from it. And how it works, once Once this, let's say suppose you're targeting to this and you're targeting to price which is 3860, so it means, and your the strike price is this, so your strike price is this 3860, but the actual spot price of this particular contract is, which is something different, which is a market price. So it means your contract should be moved from this 389789 to the different, so it means it should be 38,900 or 1,000. In that case you will have a big profit in your pocket. Otherwise, if this goes down from this, then your contracts turn into the negative figure, and even the premium of this particular will eventually goes down, or it will reduce. So in that case it will have a loss. Okay, this is how while selecting the options. So let's say now in that case the market price, which is something different, 38,789, and the option price which we are looking for 3860 CE call option. So in this case, so we are selecting the in the money in the money call option. Okay, in the money. So this is, and let's say the market price is which is 38,700, and we are looking for the 39,000 strike price, and again we are looking for call option, call that we want to buy it. So in that case, so premium which will have to be around 13 300, or total premium which is required which is 7,000 or 8,000, around 8,000. Okay, so in that case, see, the very important is the what is the current market price of this bank nifty, which is 38,700 something, and now you're looking for 39,000. Sorry, you have expectation that so it may go reach to the 39,000. That is why you're targeting to the 39,000, and in that case it means this option is away from the spot price or the current market price. So this option is actually out the money option for us. Okay, out the money. And let's say now we have discussed about in the money. Now we have discussed about, just we have discussed about the out the money, right? See, the option price is important. And let's say we are looking for at the money option. At the money would be your 38,700. If we entered into this particular price, so that option would be your actually in the money, sorry, at the money. Okay. If I can so one more thing. Okay, so intraday and overnight, these are the types. While intraday, it means if you're a fresher, it's simple. So that particular contract you will have to execute within trading hours. So that term we call like intraday, and overnight it means you can carry for next business day as well. So the pricing, there would be two types of price: market price and limit price. So limit price, it means buyer or seller, they want to quote the price from this particular spread, whatever the price in this window. If you can see that price, you can select to purchase this particular contract. And the market price, which is something, so what is the current price, what is the highest bid that the seller is selling, so that price that the broker will book the contract for you, which is 859.95. that is what even we select the price as well to execute the contract. Okay. mm, okay, that's fine, that is enough, I think. Okay, So we have seen that the ATM, OTM and ITM terms for a call option. For a put option, it works exactly opposite, but ATM will be same at the money, will be same for a P as well. Okay, there is no change. But for a okay, we'll see that first of all on the site. Let's say the current market price of this NSE or let's say NSE, okay, which is 17,516, which is the current price of NSE. Okay, now you have a speculation that the price may go down up to 17,300. If you entered into this particular P and if you purchase it, so this particular contract would be the in the money for you. You're looking for the price may go down, right? And if you, okay, wait a minute, I think I have some spot price, strike price, premium 400, break even at 4,000. Yes. For a put, here we'll first of all see. Yes, if that the price moves, below, so in that case it will be the in the money position, in the money, that options for a put. But what if the price goes above that, or let's say we are looking for so we have expectation that the price will below work, below the that 7,700. If you purchase this put, so this should be out the money for a put options, right? But yes, if the price increase and it goes above this 1770, so that moment will be the break even point, and after that it will have a big loss. So it means your premium can be zero when the price will reach to this. Okay, this premium total margin or premium whatever you'll pay, so it will be zero out. Okay, and one more little bit difference that you can see in the futures and options. Options are two types. Okay, one is put, so the call that we have already discussed, and put we'll discuss here, and another one is call. The futures again here either will buy it or sell it, but here if you want to enter into any future contracts which is required margin, so even you may expect questions on this. If you want to enter into future contracts, then do we pay the premium or margin? Yes, we do pay the margin. But here with the options, we don't pay the margin. Actually, the technical term which is that we use, which is premium, that we pay. Okay. Okay. Suppose you have a news that, or let's say you have a speculation that the maybe price of this particular, uh, the maybe BSE or NSE or Bank Nifty may go down or may fall due to XYZ reason. Maybe RBI, announce something, or maybe the federal made they announce something. Maybe any other, the virus that it has been detected any part of in the world, and that is what maybe you have that, research that, and which is saying so price may fall. In that case, you can decide the short strategy, which is sell sell strategy, to sell something, or to sell the price, because now we have a speculation that the particular indices will go down below this particular price and they will have a profit. All right. That is what you entered into put options. So here we'll see it on chart. Spot price 8,900, strike price which is 800, 8,800, and the premium which is required 400. So multiply with this, and now the break even point. Break even point would be at 8,400. Okay, so let's see when this contract will gives the profit to you. So it will perform above this area, above this 8,400, right? If you sold this particular contract, okay, this is the level. If you sold here and if you break to this, then only you will have a profit. So it should go down below the 8,400, then you will have a profit in your pocket. Because when you sell something, sell it means you sell always at a higher price, right? So the stock should go down, price should go down from the sell that you have executed. So let's say if we take the example of Wipro, and okay, this is a chart of a Wipro. If we see, if you have a news that maybe in upcoming quarter there won't be the robust performance of this particular Wipro, and it's a high chances of that the price may go down of the Wipro stock. That is what you have decided to enter into the put options of a Wipro, right? Let's see here the current price was around 720 rupees per shares, and now you have a that expectations, so price may go down, and which would be around 700 or 720, correct? So if you purchase this contract, or if you target the price, the strike price, which would be around 620, right? And if you purchase this contract at here, or else if you sell this quantity at here at bottom, this, if the Wipro's price if goes above this, and if you entered into here at this level, then you will have a loss. Okay, this contract will give you the big loss then. So it means it will work above the sell price, whatever sell price that you have sell it means actually you don't have any positions, but you are selling that, and you are promising that once the uh, once the price goes down, you will purchase it again and you will recover your short position. But what if the price goes up from this particular level? Then you will not have any other you know option in hand to cover the position. So it means you will have to actually buy the shares. What the, if the price goes above this, then you will have to again purchase the securities at a higher price, and you will have to cover the position. cover the position. This is also very important word. Okay, because actually you don't have any securities, but still you have entered into this contract. So it means you have sold the securities at this price, but you don't have any securities. Physically, you don't hold any securities. You have just made a promise to the counterpart that so you will provide the securities after few days, and that is what you have sold it. And someone have even yes again committed to you. You will that transfer that security to that particular counterparty. So in that case, if you want the profit, then stock price should go down below the 700 price, market price, or this the spot price. And if this goes down, see this till here, and suppose this was your the Wipro PE that you are looking for, which is 620. So this should be break, and once it is break, actually you will have a big amount of profit in your pocket. And if this happened before the expiry, then it's a very high chances to get the or to multiply the one premium, whatever premium that you have paid. If you see Wipro option 620, see this, it was 10 rupees price for this particular option in the month of Jan, and now if you see the Feb month option, see the price, it was made high around 80 rupees or something 84, and now again which come down. But yeah, see the price change. This is how this option price works. Okay, so we have discussed about again put options. If again for a put option as well, your unlimited loss would be, sorry, the total loss would be your the premium which you have paid, and maximum return, there is no any criteria, but yes, the return would be unlimited, or depends on you where you want to take the exit from this particular contract. Profit when the bank nifty does not go down and option expires unexercised. Loss when the bank nifty goes down and option exercised. Short. So these are the strategies, but yes, you can read this document. There are a few technical terms, or if you are enthusiast to do the trading, you can do that. Buy one future, buy one put. I don't want to discuss about the strategies because there are so many strategies on this particular document, but I just wanted to cover the terms, okay, which you can see in the derivative contract, especially in a put and call options, and how they work and all. So which will give you the the good I would say understanding about this particular put and call options, and even which will help you to understand it in a better way. And I would request, like, if you don't have any demat account, just open the demat account, and just try to check the all this information, how the derivative works and all, how the calls they book the contracts, or to create the contracts, how they expire, what happen if the contract expire. Just say don't do trading and all. So I don't want to, you know, advise anything about the derivative trading and all. But for information purpose, for a knowledge purpose, this is very important that you guys are, actually that all the informations where that you're accessing it to check and all, because somebody, see, I can cover only theoretical aspect, but when you actually go and check all that things, then you will have a good idea about it, how you can check and all. Yes. So yeah, you can do it if you want. You can go there and check it on our website as well, or else you can open the account and then check it. Would be better to get the good understanding about the derivative and all. And I hope this session will help you to understand the key terms, ITM, OTM, in the whatever terms are there, break-even point and all. Those would be very important from our interview point of view as well. If you're a fresher or experienced, that's fine, but you may expect questions on this, because in every technical interview you may expect at least 2 to 3 questions on a derivative part. So go through it, read all the technical terms. There are so many, but I'll try my level best to cover all those. Okay, and that again would be in details. But yes, be there, stay connected with the channel, and even you can subscribe it or share this with others who those are desperately looking for a job. And at the end, so I'm offering, so we are actually offering the mentorship program to the students, especially who are freshers. So they can join with us. So we'll advise them how to prepare for interview and all. Okay, so you can call me, you can text me if you are a fresher or student. So we'll discuss the further process. Thank you.